QuickBooks Online 2025 Vertical Analysis Profit and Loss Report, which can also be called a P&L report or income statement. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser, searching for that QuickBooks Online test drive, the free sample company file available to everybody. Looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. We're going to be choosing the United States version of the software, and then we will verify that we're not a robot. I'm not a robot. You're the robot. You're the robot, QuickBooks. Stop projecting on me like that. I don't care how many times you try to turn things around. You ain't flipping the script. You ain't flipping the script on me. You're the robot. All right. I don't know why I got all upset there for a second. Let's go ahead and open the reports like I do every time. Let's go to the reports on the left-hand side. And then in the standard tab, we're going to go to the favorites, right-click on the balance sheet, and open a link in a new tab. We'll right-click on the profit and loss, open a link in a new tab, tabbing to the middle, closing up the hamburger. Let's do the range change. We're going from 010124 tab 123125, selecting the drop-down to see it in years, run it to refresh it. 2024 and 25 is now side by side, repeating the process. Closing the ham boogie, changing that range, going from 010124 tab 123125, selecting the drop down to see it once again in years, running to refreshing. We're looking at the profit and loss this time. Last time we did a horizontal analysis comparing period to period. This time we want to do a vertical analysis report, basically breaking out the one period we're looking at into a percent format, which is quite common, not only for comparisons to prior data of our information, but also once again to benchmark to other businesses to see how we are comparing to them. So let's keep this as our default, open up another P&L report. So let's go to the reports on the left-hand side, open up another one, right click and open link in a new tab and see what that one looks like. Looks the same. It's another profit and loss report. Let's close it out. I'm going to make the date range for 2024 this time because that's where the data happens to be at this point in time, noting that QuickBooks will probably update it to 2025 somewhere within 2025. So open the date range to where the data is in the practice file. 010124 tab 123124. So I'll do it for the year, keep it in the totals, run it to refresh it. There's our standard profit and loss report. Remember, in the P&L profit and loss, otherwise known as the income statement report, reports information for a time range, meaning it has a beginning and an ending, similar to basically resetting the odometer. If you want to see how far you're driving, you can reset it to 0 to see how many miles you go, say, in a day. That's what we are doing here. Performance reports. Now, when we compare it to another company, if we're benchmarking somebody else, we can't really compare our dollars to their dollars. So for example, if we had that simple burger shop and we were trying to compare to McDonald's, because McDonald's we're thinking is doing pretty well for itself, and we'd like to mirror some of that prosperity with a bit better business over here, we can try to mirror what they're doing. So how would we do that? Well, I can't really compare the dollar amounts of their income versus their expenses because they're going to be a lot larger for McDonald's, but maybe I can use a percentage of income report. And if you don't like McDonald's, I'm just using that as an example. Some people get offended of the random things. You're using McDonald's and SpaceX as examples. Those people are horrible. It's like, I don't believe that person, but you know, you can choose whatever benchmark you're looking for, whatever business is actually, they should be making money though. If you're comparing to a business, you want to choose one that makes money. Don't compare it to a government organization because they are totally inefficient, right? You're kind of defeating the purpose if you do that. In any case, let's go ahead and select the drop down here. Now, we're not going to do a horizontal analysis, but rather a vertical analysis, which looks a little bit different on the performance statement than it does on the balance sheet. You notice we have a few other options down here. We're going to be choosing the percent of income, which is the most common option. So let's go ahead and run that. And just to compare that to the options on a balance sheet report, which is a report as of a point in time instead of a performance report, let's take a look at that over here. Look at the drop down. Look at the drop down. It only has percentage of columns, which you will recall if I click on that, gives me the percentage is as they compare to assets compared to total assets, liabilities and equity compared to total liabilities and equity. But on the income statement, you will remember we had more options if I select the drop down. And we're not going to pick the percent of column because it's not just adding up to the bottom line and then we take the percentages of the bottom line. Typically, we want to compare all the numbers to the thing that we are in business to do, that is to generate revenue. Now, again, you might say, hey, look, I have more. That's like, you're greedy, man. I'm saving the world with my business. I'm saving the world with my business. I've cut the hair of poodles, and by poodles being happier, the people are happier, and then the whole world becomes hippies, a hippie commune because they have happy poodles because I cut their whatever, dude. Okay, if you're going to save the world by cutting the hair of poodles, you need to at least make revenue, or you're going to go out of business and the world's going to be unhappy and then kill itself because it doesn't have trimmed hair on the poodles to make them happy, right? Whatever. So it's revenue generation. That's what we're going to go for. So I'm going to say, okay, now if I was to see this in the modern view, let's just check it out in the modern view so we can look at it. If I did a comparison report, we have, and then we'll select the calculations over here, and we've got the percentage of income. So that's what it looks like on this view. So we're going to then go back on over. Let's switch back to the classic view. We're going to go back and forth here, back to the classic view. And so what is this doing now? What is happening here? What is even happening? Well, instead of having period to period, and then the percentage representing the percentage increase or decrease, we're taking the percentage not of the bottom line, which is net income, but of total gross income. So the income statement itself, as we saw before, is basically income minus the expenses. Income minus the expenses. Now, there could be more pit stops along the way. We might have cost of goods sold, and then gross profit, and then expenses, and then other income and expenses. But basically, it's going to be income minus the expenses. The income is what we're trying to generate. Cash will typically be coming in as we generate income, although income itself, when reported on an accrual basis, is based on when the work was done, not necessarily when the cash was generated. The expenses then are the things that we consumed in order to generate the income. So therefore, we want to compare everything to the end goal of the generation of income. You can see the income line item has 100%. That's what we would expect normally from a vertical analysis type of thing, such as we saw on the balance sheet, where we took a percent of all the assets compared to the bottom line of assets, as you would see similarly if you were in a finance business or you're doing your finances and you're looking at your asset portfolio between stocks, bonds, and so on and so forth. On the income statement for the income, we have a similar kind of calculation. Now remember, this business has more income line items than most. Most businesses might only have one or two income line items because they only do one or two types of things, even though they have many different customers and possibly many different variants of the things that they sell or services within their overarching, thing that they do. So let's take one of these. So for example, if I took this 1040, let's just take the total here. Let's take this one. This 3384.97 divided by the total income. So here's the total income, which is 5903.47. We get the 57, if I move the decimal 2 places over, 57.34% about. So that the income line items are kind of what we would expect. Each one, if I add all of the percentages up, it comes out to total income. So if I was to compare this to if I was comparing my business as a burger shop to like McDonald's or something, maybe we break out the income line item by, our services that we sell, and then versus maybe we have another income line item for toys that we sell or activities that we have or something like that. We wouldn't break them out by every different burger that we sell typically, right? Or every customer. And then on the expense side of things, this is usually where the bigger category is at. because oftentimes our objective on the income side of things might be, for example, to change our prices and whatnot in order to benchmark ourselves to be competitive. But oftentimes from there, we're really thinking about where should we be spending our money? How much money should we be spending on the things that we have to consume in order to generate the income? If you have cost of goods sold, that's going to be one of the major important things, right? So if I sell inventory, the relationship of how much we spend on cost of goods sold versus the revenue is the biggest expense. That's going to be something that we really focus a lot of our time on. So for example, from a very simple kind of process, if you had like a hot dog stand or something like that, you have pretty low expenditures on the cart and whatnot, the overhead cost and whatnot. How much you spend to actually buy the hot dogs is going to be really important, and you're going to compare you're possibly going to set your price based on how much revenue you have to generate in order to pay the fixed cost, the rent of the hot dog cart, right? And then again, we can once we get that idea down, we can compare that. If I was a burger shop and I'm comparing to McDonald's, I can try to say how much do my actual burgers cost compared to what I sell them for? Is my markup similar to what they have? And then all of the other expenses that aren't actually the things that we sell are usually going to be a lot lesser compared to the revenue line item, but we still want to keep them in range. So for example, what's the next biggest thing we spend money on? If you're like, if you sell things online or something like that, or let's say that you do gig work even, and you make a content creator or something like that, you might be spending a significant amount of money, therefore, on advertisement, which is always a bottomless pit that you can put money into. It's important, but I mean, like I said, it's not my thing. I'm not real great at it personally, obviously, but I try to, hopefully I get on the right gig work to get on other platforms so they can help to sell my stuff, because I'm certainly not an expert at it. But I also think that the advertising budget always wants more money, from my experience, right? They want more money, and that's just the way it is. So the question is, are you getting the bang for the buck? Are you generating the revenue from the amount of money you're spending? Did you spending all that money on the Oscars commercial where you had somebody drinking something and you don't even know what it is, but for some reason that's going to sell your products, even though your product wasn't even displayed on the screen. It was just a bunch of weird people in different colors dancing around looking crazy. And I'm paying for that. I'm paying for this commercial. This is what's happening here. How is that gonna make? Okay, advertisers, dude. I'm telling you. So anyway, I try to avoid them personally. Okay. But you can see how much you pay for the auto expenses, obviously, and then you can go through how much do these expenses cost compared to the income. So for example, if I look at, obviously the big ones are typically going to be inventory, cost of goods sold, and then possibly advertising, or possibly your wages. How much are we paying out for wages? For example, if you don't have employees, you might have contractors. How much am I paying out for contractors? Those are usually the big ones that you can kind of compare to other businesses and say, how much are they paying out to their employees? And so on and so forth. Are we doing a comparable type of business? All right. So if I was to do a ratio analysis, it would be like, this would be the 443.35 compared to divided by the total income, 5903.47. And if we move the decimal 2 places over, we have 7.51%. So I can compare that number to, say, if I was McDonald's to see how much they're paying for, this is job expense, it's not very specific, but legal expenses. I can compare my legal expenses to their legal expenses on a percentage of revenue basis. That would make sense. Now note that you do have these other comparative reports. So let's just take a quick look at them. This is the most common one. So when you're making your standard financial statements, you might want to include a percentage of income statement, which you might call a vertical analysis. But you do have these other ones. If I say percentage of the column, so now if I was to minimize everything, you can see that we have still a percentage of, did I run it? Let's run it. So there we have it. All right, there we go. Now this one doesn't make a whole lot of sense normally for an income statement, but you can see it has the same option, and it might make more sense. That's the one we used when we were on over here on the balance sheet, right? We chose the percentage of a column, which took the percentage of the bottom line total assets and liabilities. In this case, what's the bottom line of the income statement? Net income. Does it make sense to compare to net income when you're subtracting things out? Not really. Like, that's where this number is coming from. So 5903.47 divided by the 152.85. If I move the decimal place 2 places over, 3862. So again, what I would say mostly is when you're making a vertical analysis financial statement, you want to make sure that you remember not to check this one off and check the percent of income one off. Now you could take the percent of expenses. So let's just take a look at that one. And now we're comparing everything not to income, but the expenses. Now this doesn't make sense really from the income side of things normally, but it does kind of make sense if you just look at the expense category. So the expense category, it makes sense from the expense category to look at the percent of what we consumed as compared to revenue or income. But maybe it could also make sense for us to look at my total expenses and compare each line item to the total expenses. So of all the expenses that I paid, for example, here's the utilities. Let's say how much is utility compared to my total outflow of expenses, 331.39 divided by the total expenses of 3140.32, and that gives us our 10.55%. So that might be useful, something that we could use, but it's not as common as comparing everything to the total income. So let's go back to total income and just do our normal formatting. So remember, this is the one. This is not that one. This is the one. This is the one that is common that you might want to add to your package of reports. So we run it, and then let's customize it. So now I might want to change the profit and loss to maybe an income statement and maybe a vertical analysis income statement. So let's go to customize and get rid of the cents. Make the negative numbers bracketed and red on the headers and footers. I'm going to get rid of the date, time, report basis. I'm going to say it's going to be a profit and loss. Let's change it to income statement vertical analysis. And we'll say, okay, run it. So now we've got it looks nicer. That looks good. All right. And then if we wanted to save that, then I can go to my save customization. Let's make a group. I'm going to put it in a group of month-end reports and reports. Add it. Maybe I put a 1 next to it if I want this to be my first report. Save it so that when I do my month-end reports and I want to pull this one up, I can go to the reports on the left-hand side. We can go to the custom reports, and then we can say refresh up top. And then we could just pull up our custom report here. So that's good. So remember, the vertical analysis on the income statement then is going to be comparing to income, performance report, great report to compare, benchmark us to another business so that we're not comparing dollar amounts, but we're comparing percentages, because most likely the other business makes more money than we do. That's why we're trying to copy what they're doing. Whereas if we did the vertical analysis on the balance sheet, you can imagine that it's taking the total of the column, which in the assets, for example, would be similar to, like, if you're talking about the investments, breaking out the percentage of stocks versus bonds and so on. That said, I had my investment broker wanted me to put my investments in multiple baskets instead of just one basket. And I was like, what? I don't want my investments in any basket, Put my investments in a safe, for crying out loud. Honestly, anybody can break into a basket. They're not safe in a basket. Put your investments in a basket. If you put your investments in a basket, you're liable to get robbed by, like, Yogi Bear, who's just looking for a picnic basket to get a sandwich, for crying out loud. Put my investments in multiple baskets. I'll put you in multiple baskets if you touch my... Anyway, I'm just kidding. You want to diversify, but I wouldn't put my investments in a picnic basket. That's where sandwiches go. Just so you know if you're talking to investors.